owns 20 houses, which are leased to tenants. The houses are located in the same area. The fair value of the consideration paid for the shares in SACAS is equal to the total fair value of the 20 houses. Required. Apply the optional condition test in IFRS 3 business combination to determine whether SACAS Limited is not a business. And to be honest with you, guys that are doing ACCA, this is how your question is going to come. For guys that are doing ACCA, this is how your question is going to be coming.
Sir, I think there's a joker in this question.
There's a joker there.
Yes.
Exactly.
The joker is a non-listed company.
So does that change your opinion?
Yes, it's making me want to change my opinion.
I think it's not a business combination because
So
based
why
on
do
the
you think it's a business
concentration
combination?
test, you said there must be inputs, which are the resources, the employees, then a process. They didn't state any process they've gone through in terms of the combination here. Though there's the output, which is the main consideration. So I think it's just an investment that he did. Okay.
So let me ask you, what is the, assuming the 100 share worth 100 million, what is the input?
100 shares worth 100 million.
So what's the input?
To me, I feel there is an input.
So what's the input? What's the input?
The input is the value that they will pay for this 100% of the shares.
Thank you. What is the resources? What is the process?
The process.
Yes, what's the
I
process?
believe this company is a real estate institute. They would have workers, they will have managers. Those are the process. There's already a process, but it is not stated in this question.
So in this question, can you say a process? In this question, can you say a process?
No process in this question.
In this question, what is the output?
So maybe you need to take us through that concentration test again.
Yes, exactly. Okay. Okay. There's no process in this question. There's no process in this question. In this question, it is an investment because we have our input. There's no process. We can actually say there is an output because there's going to be rental income. But the issue with the rental income is that all the risks are coming from one source. All the risks are coming from one source because the question told us that SACAS Limited owns 20 houses which are leased to tenants. The houses are located in the same area. Risk is concentrated in one place. And the fair value of the condition paid for the share in SACAS is equal to the total value of the 20 houses. That is basically the fair value at the end of the day, which is the output. But there is no process, right? Don't let us judge. Can we look at this knowledge too? Who want to read knowledge 2 for us? Knowledge 2.
Let me read. Flash Change purchased 100% of the shares in Steady Exchange Limited.
Sorry, just to cut it short, anytime you are making your decision, whether they tell you is a listed or non-listed company, it doesn't affect your decision. So listed or non-listed company is just a distraction.
Okay.
All right.
So Flash Change purchased 100% of the shares in Steady Exchange Limited, a non-listed company. Steady Exchange owns 10 houses which are listed to resident tenants and 2 multi-store office blocks which are listed to commercial tenants. Steady Exchange has no employee, with all property management tasks to be performed by other employees from within the Flash Change group. There are contracts in place for third party to provide cleaning and security service to the commercial tenants. The total fair value of the house is similar to the total fair value of the office blocks. The director of Flash Change were to apply the option concentration test to determine whether pi is, I think that should be Flash Chain. Okay. Whether Steady Exchange is not a business. Required, discuss whether Steady Exchange constitutes a business.
So what do you think? Want to have a read again?
Let me take a glance again.
Oboife, what do you think? Omoife, what do you think? It's like Omoife is far away from us.
So is it possible for us to take us through the elements?
No, I'm not far away. I'm quietly absorbing this one in.
Okay, because you've been quiet.
Yes.
So
I
I
want
want
to really take it.
Somebody was saying something again.
Yeah, okay. I will just suggest if you can define the input, the process, the output again, so that it will also help us to form a good background of the decision making.
Okay, let me. I said that for you to have a business, 3 things you need to carry out what we call a consolidation test. And consolidation test comprised of 3 things: the input, the output, and the process. So if you invest any amount in a company, that is your input, right? What we have given out, what we have dished out, I acquired shares, I bought this, that is your input. Your outlay, your initial capital outlay is your input. Now, process is now determined as resources. And in terms of these resources, we are talking about employees, experienced staff of the company. Those are the resources, right? Now, your output basically represents the gains in terms of what do you gain if I buy GTB shares, right? If I invest in GTB, what I invest in GTB is my input. But looking at GTB, the GTB has experienced staff in their IT that can make sure that the company is not, my fund is not at risk. Does it have managerial skills, top management team that is working within GTB? Those ones are my process. Then if I invest in GTB, what is my expectation at the end of the day? Is it that I'm expecting them to declare a dividend or to have a kind of a gain? Or if I'm adding that transaction for sales, okay, in the next 6 months, 7 months, if I'm selling this equity, something must be coming out of it. My savings, rental income, that is my output. Does it make sense?
Yes, it does. Yes.
So can we now shoot? Can you now shoot? I want you to shoot on this one.
Okay.
I'm not using anybody.
Okay, thank you, sir. Okay, based on the definition of the input, process, and the output. Now, the input is the investment, which is the Flash Charge purchases 100% of the shares. That's the investment. Then the process, that's the employee that carries out the function, which is performed by employees from within the Flash Charge. So that's the process. Then the output is the gain, okay, which is also the fair value. The total fair value of the house is similar to the total fair value of the office block. So based on this definition, so I can say that there is business, constitutes a business.
Can I ask you a question?
Yes, you can.
Now, let me just divert a little bit, right? Just a little bit. Under IFRS 10, we have the investor and the investee. Although let me use tough language, let me use simple language. We have the parent and the subsidiary, right? The parent company is the one that is investing in the subsidiary, right? So if, let's say, for example, Flat Change has acquired 100% shares in Steady Exchange, this is a simple group. It's not a complex one. We are not even talking about horizontal or vertical. It's a simple group. That means Flat Change is the parent company. Steady Exchange has now become a subsidiary, wholly owned subsidiary, because it is 100%, right? Now, when you are trying to make your decision, I'm just trying to give you a background. You are looking at in terms of process. Does Steady Exchange, the subsidiary, do they have processes? Processes that I'm investing in Steady, Flat Change is investing in Steady Exchange. Does Steady Exchange, do they have these processes in place? And the process I'm looking at in this scenario is, do they have experienced staff to manage the business? Because that's basically one of the things you want to look at. If you're investing in a company, you are just not looking at the quantitative aspect of it. You're also looking at you're not looking at we call it quantitative and qualitative. You're not looking at the quantitative aspect of it, you're also looking at the qualitative aspect of it. Who are the caliber of people that is going to be managing my money? So in this scenario, I'm just trying to digest this thing for you, and I'm going to take it from here.
Okay.
Second line. Steady Exchange own 10 houses, which are leased to residential tenants, and 2 multi-story office blocks. Not one risk. The risk has been diverted, right? Which are leased to commercial tenants. Yes. That means they are not residential. These are commercial. These are offices, right? Steady Exchange has no
employees. Okay. Yeah. Okay.
It has no employee. Yes. That means there is no process.
Yeah.
There's no process. Can you see that?
Yeah.
With all property managed tasks to be performed by other employees from within what? The holding company. The parent company. Right? Group. There are contracts in place for a third party to provide cleaning and security. No resources. Because it's a third party, right? To the commercial tenants. Making sense, right?
Yes, it does.
So what do you think?
No.
The question for you. What do you think?
No, they don't constitute a business because they said Steady Change has no employees.
It has no employees, no resources.
Yeah. So there is no business. It doesn't constitute a business. Yeah.
Are we making sense?
Yes.
Yeah. Then also there is no output, right? Because if he's purchasing it at okay, it's later on the start getting the income from it.
Yeah, they said there will definitely be output because they said that the total fair value of the houses is similar to the total fair value of the office blocks. Okay. There will always be fair value.
Okay.
And the fair value is like, okay, this is what it is. So there will be output.
I have a question.
Yes. Go ahead.
So I will be raising our hands.
No problem.
So I think Sandra has raising her hand for a while. Okay. So now this is where my challenge is in this question. Flash charge, because in my own opinion, I think it should be a business combination because Flash charge change purchase 100% of Steady Exchange, which means if we are looking at it in the tax form, they are a 55% group company. Then also in terms of consolidation, it's Flash Change owns Steady Exchange. So therefore, even though Steady Exchange does not have any staff, which we read then, However, they got staff from Flash Change, which is their parent. So, which means they'll be paying what's called management charge to the parent company because they are using from the resource of the parent, which is the same as them because they are one group company. So that's why I believe that this is a business combination. Well, I might be wrong, but I just need a little bit of explanation on that because this
Thank
one it looks a bit tricky because they already have staff which they're using from the parent company, which is to me is a resource and a process.
So thank you. Yes, I will almost agree with you, but I will disagree with you because
Okay.
here, because here they told us that order by steady exchange has no employee, with all property managed tasks to be performed by other employee from within the flat chain group. Now the question is, who are those employees within the flat chain group? How are you sure there's going to be a charge out fee or charge out rate, like you said? Because yes, other employees doing that thing. How are we very sure that okay, there'll be going to be a charge out rate to that employee that is managing it
But
as additional cost?
sir, we know that practically there will be
Yeah,
a charge.
tactically there will be a charge. Yeah,
Practically, yes, there will be a charge.
practically there will be a charge. Yes, there will be. There might not also be practically.
Okay.
There might not also be practically. There might not also be practically. So let me give you for example, right? So my firm is with head office in Lagos, in Glasgow, quoted on London Stock Exchange, right? Then with branches in Germany, Czech Republic, France, right? As the head office located in UK, quoted on the London Stock Exchange, practically means that whatever we present to the HMRC is going to be the group consolidated report, right? Now, we only have just one accountant in Germany that manage the people. And the reason why he's managing that people is because they are German speaking country, right? And he can always tell them this, right? Revenue, salary comes from UK, is being paid in pounds, even though it is domiciled in Germany, right? Now, there are operation in France, there are operation in Czech Republic, their operation in Italy, right? And basically, everybody working in other country work remotely, being paid local currency. But when it comes to the reporting of that particular branch, because there is no accountant in those regions, everything work through the system that is owned by the group. No charge out rate. That means I just need to look at what number of sales going on in this wherever. I can go to the CRM portal and say they are making this volume of revenue in Czech Republic, and I'll match the revenue to say, okay, this is what should be reported from this particular revenue because there was not somebody that's reporting that in. And how we report Czech operation, convert everything on HMRC portal, exchange rate, conversion rate, and put it back to UK value. Naira equivalent. I don't think I get a charge out rate. So when it comes to operating expenses, resources, nothing is charged out to those regions where there is no staff, even though it is being managed within the group, like flash change, because it's being managed within the group. That means, but there is no accountant forever. So does that mean that they will say because there's somebody in the head office doing the monthly end of reporting for that region, there should be additional income, which is not part of my contracts, to be honest, because those are just new operations that just pick up. Czech, France, Italy, and one that just came up. Germany has always been there from the onset. And I'm actually doing that job, and I don't think I've had a charge out rate. Additionally to me, as the head managing those resources to say, yes, apart from people taking up booking on a contract basis, nothing is being charged out. So, and I don't think practically it might be charged out in reality. So it can always be dicey.
Okay, thank you so much. I think I understand what's happening there is that the company is operating more like a, I don't know what I call it. I want to use a word called ghost, sort of like nobody's is there at all. That means the
Nobody
business
is
can
there.
auto run on its own.
Exactly.
That means it's not really a business they are running then in that case.
But you can't say it's not a business because it's still generating. There is an input.
Yeah, but
There is
there's
level of
nobody in that
compliance in
place.
terms of incorporation with in France, in Czech.
And you
The
don't
company
raise
is
any
not a
management charge for your company. Like it won't come to you, but management charge in the account that comes to the company.
management charge that comes to the company.
Yes, because normally when I'm auditing such kind of company, I expect to see management charge. But the problem now is that where our problem is that there is no director at all in that company or that country or anybody at all.
No,
Then
there's
that
no
will be a
director.
problem for me when I'm auditing it. So
Yeah,
I know
because
that
the directors that will be in that country will still also be the one that is based in UK. It's just like an
then,
extension.
in my opinion, then there's nothing. It's just like I don't know what to call that kind of business. So
What will you
because
call it?
I don't know what to call it. There's nobody at all that can give me any far from there apart from you, the same person in the head office.
But to be honest with you, is exactly that auditors, you guys auditors, right? Right? You guys auditors, and you guys, I know the level of details of work that you guys does. To be honest with you, because they ask question, the documentation of Azeti is very, very strong. At the point I'm like, why do you need all this so much documentation in terms of reporting requirements? And even me, the first time they were asking me a question, like, and the guy was typing, I was like, are you what is going on? So what is going on? So the question is that yeah, I don't think there should be an issue because basically it's an entity, right? It's an entity that is based there, which will always exist. But the question is that why do you need to say if it's not good because transactions are going on, revenue are going on, and I can actually even trade that revenue to region, even in terms of my revenue analysis. I can tell you this is how much that I've generated from this region, UK,
Yes,
Germany,
then that's correct.
France.
That means it's not a business. That's correct. That ties back what I was
So
thinking
what can we
in
call
my
that
head.
kind of
It's not a
stuff then?
business
What can we call it?
because revenue is for your company. You just those that is just like a vehicle. It's like just like an SPV. Like
Exactly.
it's not a business. So it's an SPV. Head. That's what I was thinking in my head. So therefore, it's not a business now. In that
Yeah.
case, it's not a business. It's an SPV.
It's definitely it can't be a business. So how does that actually tie to this to say this is not a business? To say steady exchange is not a business.
Yes, it ties. But the way it was, I'm looking at it in this question is like Steady Exchange is like a company that we bought initially, digger which we own 100%, which means we bought it outrightly. So in my head, it's like, okay, there is a structure in place somewhere. There is at least a director. There must be a director in company's house, or if not company house in that country, that is a director there. Except if when they now bought it over, since it's 100%, which you are correct, they will have bought it over, then kicked away all the directors, and then the shareholders will change on company's house. CSO1 will change in that situation. Then they then decided to turn to an SPV and then they run it from the UK, then in that case, it makes sense.
Okay, let's look at it this way. We are just learning, no? We are just learning. We are just learning, right? Let's assume Moses, Moses Limited now acquire Steady Exchange 100%, right? What's going to happen to the directors of Steady Exchange?
Well, I can decide to keep them or to remove them because directors are not essentially shareholders of the
Okay, they are not
company.
shareholders. That's fine.
Yes.
What happened to the shareholders of Steady Exchange? Let me use that word.
Automatically, I'm going to file CSO1 on my confirmation statement to kick them off.
So, does it necessarily you have answered the question? You can actually decide to keep them as directors,
Yes.
but the shareholding does not belong to them. So, what are we talking about here? Shareholding. We're not talking about the directors.
Yes, that's correct.
So that's what is happening. So invariably, we are not looking at the entity to say who do we wanted to see in that people. We are looking at who are the owners of this business, not the directors itself. So we are looking at it in terms of equity, not actually in terms of to say business, not in terms of to say does the director exist or no director does not exist. Definitely, there's going to be an equity holder, and the equity holder can either be two. It can even be the company itself being the equity or an individual. having been the shareholder. Because you, Moses, might not decide to put your name, individual name, as the shareholder in the trading exchange. You can decide to say the shareholder in trading exchange is Moses Limited, but represented by you, invariably still one of the directors in Flash Change.
So I want to ask a question. Sorry, a bit deviation, but a bit of understanding. I noticed that, for example, in the company, the person who has more power is the shareholders, right, than the directors, based on my knowledge of IFRS 13 and IFRS 10. Sorry, consolidation. And then, am I correct, sir?
So, so when it comes to that, we are talking about right, power. Yes.
Yes.
That's
Okay.
just the word. Yes. You
So
want to use the word
now,
power. Yes, right.
now to my question.
Yeah.
In the UK, as a shareholder, you tend not to be able to do things on your, maybe like on your company house, or your company with banks. They tend to ask you to bring directors, even though you are a major shareholder of the company. I want to know why is that logic like that? Because I've had reason to on a company to do something with banks, but bank will say that no, you are not a director, you're only a shareholder. So I want to speak to a director. They don't want to speak to me as a shareholder of the company. I'm wondering, it does not make sense to me. In my mind, it's like, I can sack this director. So why are you saying you want director and not me, the shareholder? Who, of course, director is my staff, which I employ, who is working for me. So I'm trying to think about rationale. Does it mean the director can now decide to change things on my behalf, or if he decides not to do things for me? So I'm just trying to think about that, how it makes sense.
So the reason why it makes sense in UK, why they actually likely wanted to speak to the directors, because we want to look at the context of the word directors. Directors are people that manage the business, understand the business. So, and one of the things that this financial institution want to look at is that they are looking at one side of it to say, we want to understand your business concept. What do you do? Banks in UK don't just want to take your name. They don't just want to take your money. They just want to look at, are you doing a legit business? So they need somebody to see them that to say, this is what we do. This is our operational level. Yes, a shareholder can do that, right? But they feel like, yes, you're a shareholder. Are you a shareholder as well as a director? That's number one. Number two, don't forget that in most cases, right, banks want to deal with the CFO. I will just break this thing down. It's a two-way thing. For all quoted company on the stock exchange, right? London Stock Exchange, the CFO must also be a director. So that means when they promote you to the position of a CFO, you must be a director. And there is almost likely chance that if you're a director in that company, you are having a share in that company. That share might come in a two-way, right? It might be that you purchase that share, or you must have acquired that share through a share option. That means the company has a kind of a share option they give to the staff at the end of the day. And maybe you have been working there for so many years or whatever, and they were giving you bonuses. And the bonuses does not come basically monetarily, but they are giving in terms of a share option to say you have these shares in this company, which goes with policy around that share option that you need to work for us for so number of years. Otherwise, if you leave, we need to actually take it away from you and monetize it, and so on. So basically, it's understanding business processes more than whatever. So, but the director can actually put to say these are people that have authority to transfer, to move money within the company or the banks. I think that's just my own. I think might be the logic behind it. All right, are we good to go, please?
Yes, sir. Thank you so much.
All right. So basically, here there is no resources because Steady Exchange itself does not have resources, right? Let's look at this third option, right? Who wants to read for us here? I think I need to start calling names now because some people are hiding under the bus. Sandra has always been talking. In fact, Sandra should win an award. Owupele, do you want to read for us, please? Are people running? Are you here?
Yes, I'm here.
You want to read for us?
Let me go through the question very well.
I'm very sure you are not reading from your phone today. Oh.
He said,
Are you reading from your phone today?
Let me read.
All right, shoot.
Energy Grade purchase 100% of the ordinary share capital of H4 business, an entity that does not yet generate revenue. H4 business operates in a biotech industry. It has engaged in research and development activities into a number of drug compounds and also owns a headquarter research laboratories and technical equipment. H4 business employs senior managers and hire highly skilled research scientists. Each of the H4 business assets has a similar fair value. There's no
So,
question, but
the
I think the
question
question.
is it a business or not? The question is it a business or is not a business?
It's not a business.
It's not a business. Why do you think it's not a business?
No input.
No input.
Yes.
yes.
What?
There's input now,
No
sir.
input. Why do
Yes,
you think
Sir,
now.
there's
there's
no input?
input.
They said they've not
There's
started generating
input.
revenue.
Sir, there's input. Use money
There's
to buy
input
it.
to
Where is it now? It has engaged in research and development activities into a number of drug
Sir,
compounds
the purchase is
and
the
also
input.
owns a headquarter research laboratories and which business
Sir, the
employs
purchase
senior
is the
staff.
input.
Okay, go on.
It has staff.
Process.
So my
Process.
process.
challenge is that I don't know if buying them as a research company, they can now use it to now start producing something. But originally, there is no income stream. So maybe they are just going to gain goodwill. But it's the output now that is giving me problem. But there is input and there is process.
Is the input not supposed to be the income stream?
No,
Okay.
It's the
that's the
purchase,
output.
the amount you use to purchase them.
Because no income, that's where me I generated
That's the
income, that's where me I
output.
is.
That is the output. The income
Oh,
stream
okay,
is the
okay, okay.
output. The input is what you actually invested in the company, and Energy
Okay.
Grade has invested 100% ordinary share. That's the input.
So which means they don't generate income yet. So that means it does not constitute a business.
It's a business combination. It's a business, sorry.
It's a business. It's a business because here there is an input. Here there is a process because they have senior management and highly skilled research scientists, right? But they are telling us that they are yet to generate revenue. Does not mean that they are not going to generate revenue in the future.
But you told
Right?
us, sir, that we should stick to the question.
Yeah.
That we should not forecast for the question.
We are not forecasting for the question.
So going by your word, they've
Yeah.
not generated revenue, so there's no output now. There's not a business.
There is no output. Yes.
Sir, can you define the input
We use
here?
your word against you, sir.
Sir, can you define the input here, please?
Can I define input?
Yes.
Input in this scenario, right?
In this scenario, yeah.
The input is the whatever amount they pay for the shares in H4 business. That's the input. Whatever amount you put in, you use in acquiring that asset is the input. So here they are bought shares. So the shares here, whatever amount equivalent of amount of that shares is the input. So, and we are told in this point that they purchase 100% shares, which is similar to what we have here. They purchase 100% shares, which is not what we have here. They purchase 100% shares. That is the input, right? And the process is that they have employee, something they can hold on. That is the process. They have senior highly skills, right?
Yeah.
Now, I want to come back to Moses, right? Moses, you are a senior auditor, but the question is that we have not gotten to IFRS 5 already, or it's not even IFRS 5. Okay.
IFRS 10.
IFRS 10. So the question here is that
Me, I think it's a business.
it's
And I
a
want to.
business. I'm coming back
And
to
the
I want
reason
to
why, the reason
I
why I
want
think it's a business is that all the whole analysis that these research people have done, they are going to use it to generate
Definitely.
revenue.
They look at, they said it has engaged in research and development activities into a number of drug compounds and
Sir,
also owns a
sir, I do
headquarter
not agree it's a business, sir. It's either there's a problem with the question in terms of understanding with me, or why I don't agree is because I'm going to give my reason now.
Oh yeah.
Let me even use my CCA knowledge, for example. When we're doing this thing, this kind of question used to come out a lot as question number one. And then they ask that they say that they are yet to generate revenue. Once I say that they are yet to generate revenue, I know automatically it's not a business. Because even though they've put in a lot of input, a lot of process, a lot of input and process in place, like they've put in money, they've done stuff, but the point is, have they generated revenue? Have they been able to, do they have contract? Because how do we consider a business? I'm just trying to tie it back to my what's it called, my Kaplan knowledge. Is like, what we look at is that they do have contracts in place. Assuming discuss that they have contracts in place, or that they even made some things but they were making loss, they were loss making. I know it's a business, but now they are not even yet, we are not sure that that research they are making will be successful. This question exactly comes out like exactly in this, like, we are not even sure if what they are doing will be successful in future, because they are just doing research. The research might not be successful in future. So therefore, I'm not sure. I just need you to look at that angle too, sir, in the line of the argument of it.
All right, let me answer that question, right? Let me answer that question, right? So a company that has been operating already, that has been generating revenue, is there possibility that they are likely to make loss in the foreseeable future?
It's possible, 100%.
Because they are going to make loss in the foreseeable future, does that make them not to be a business if you have actually invested in that particular business?
No, that's not what I'm talking about, sir. In this place now, is that they have
Yes,
not generated revenue.
yes, they said
It-
they are the entity that does not yet, they said HPL business, an entity that does not yet generate revenue, right? Just
yes,
that they are supposed to generate revenue. Went ahead to give us additional whatever. They said it has engaged. See, if they have stopped here and they didn't put this particular sentence there, I totally agree with you, because we are not sure whether they are going to even make any sales, or they have invoices to client that they are expecting revenue. They have not actually put an invoice, but they told us that it has engaged in research and development activities into a number of drug compounds, and also owns a headquarter research laboratory and technical equipment. This one here is an indication that yes, yes, they don't have revenue yet, but based on this statement we have here, they are more, is not something, is not something that would not
but sir,
okay.
I've seen situation like this in this kind of question, that whereby they give us something like this to in ACCA, and then we end up realizing that it's not, because they said that the fact that he's done all of this doesn't mean he will generate revenue.
Really?
Yes, it has
Ah,
engaged in research and development activities into number of drugs compound and owns headquarter, blah 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 blah. But however, how are we sure that those things
yes.
would be completed? Like, like if you engage, you can buy equipment, machines to do research and start testing those things, doing those things, but they might not be successful.
Ah. Yes, they might not be successful at once, but they will successful in subsequent year. The question is that it's not necessary that
The
they will
question
make.
is tricky. It's like I
Yes, it's
can
tricky.
tricky
In
question,
fact,
yeah.
these are the kind of question, all this scenario, especially this number three. These are the kind of scenario you see in a CCA question. Typical scenario, because at times they might give you something straightforward like this or like this, but typical this one, they will give you something like this. And for me, I think what should be forming your base of making decision is the second paragraph here, which says that yes, they have actually involved, they have engaged in research and development activities, and they are telling us even they have, yes, company must have put in a lot of resources, yes, have equipment, yes, they told us they have technical equipment, but to also corroborate that, see down here, employ senior management and highly skilled research scientists.
Which means they're likely to be successful.
More likely to be successful, highly skilled. They did not just say skill. They are telling us it's highly skilled. They have senior management team, employees. That yes, these are not just, they just employ just anybody outside that will like, okay, we are just trying to test run. We are not sure. I just came out from the I'm a training graduate. I just came out from uni and I'm trying to test run. This is not a test run. They are senior management and they always are highly skilled research scientists. I think if we are not just looking at the year to generate revenue and they were silent, they didn't give us more clue. There are a lot of clue to tell us that yes, they have something on ground. They have highly skilled resources, not just even resources can be different. Some resources like, okay, yes, let's take that resources in. This is a tested resources. They are senior management team. Not that they just go and hire somebody to say, okay, a data input analyst just be inputting something on Excel. No. And somebody else will clean it, or they will look at how do we clean this thing. They have experienced people on ground to manage the business. So for me, I think it's a business. It's actually a business. But what does any of that body think? Let's hear from. I always like to share people's opinion too. Any other people that think yes, that what do we think? What do we think? I mean, what do you
Already,
think?
Sandra already agrees already. So let's hear from Aminat. Let's have some.
I mean, what do you think? What do you
I said
think?
it initially that it's a business. I agree. It's a business.
So Aminat, you're against me too.
No, it's just actually what the what we are seeing the question here. But my own question is other ones that were not business, like how are we not going to treat them?
It will become an asset.
Like a PPE asset?
Yes.
Oh wow. Okay.
Yes. It will become like a PPE. You'll be treated like a PPE. Like you're just
Okay.
buying ordinary assets under
Okay.
IS 16.
Wow. Okay.
So once it does not meet the requirement to be a business, it becomes a PPE. I'm liking most of the IFRS that Moses was giving me. It's like there's always a kind of an upgrade from one standard to another though. Though even in my head I was thinking this would be upgraded to IFRS 10, but it's fine. But I like the IFRS 5 as well too.
That's why I'm giving you the hard ones now.
Okay. So any question? Can we continue? So now that we know
Good morning, sir.
Yeah, morning.
Okay, please, I would like to ask for this particular question because I'm saying this question as a two-way question. There are some questions that when you're giving in, for example, in ACCA, the way you answer this question in ACCA might not be the same way you answer this particular question in ICANN. So I'm saying this question because if you are saying that like if you are giving this question in ACCA now, and we answer it that it is a business. I'm saying that there's a probability that the answer might not be correct because case studies are you must follow the scenario the way they give it to you. You don't forecast for it. It's a
But
different thing.
it's based on your argument. What you can analyze to support your answer.
Yes, Aminat is
You
correct.
understand?
So
Yes,
able to
yes,
argue it. Yes.
yes, I agree with that also. So I'm now confirming. Are you saying that if we're able to argue this out, this is a correct answer that it is a business?
Okay, see, this is how I will answer your question, right? This is how I'll answer your question. I'm not a modeler, but I know more about modeling, financial modeling. So in financial modeling, the first thing you want to do is to create a scenario. Your scenario can either be base case, worst case, right? Basically, the base case they will give you in the question, but you want to formulate other scenario. But where 10 people, 10 candidates, right, on a revenue assumption. Basically, that's where the issue always coming from. On a revenue assumption, we do different things, and at the end of the day, their model will balance. Basically, their model will balance because they use different assumptions, and whatever assumption you use, as long as everything you are doing, your cost assumption, your CapEx and depreciation assumption, your debt amortization assumption, your revolver, which must be the difficult one, all of them are correct, right? Your model will balance. So where I'm going to is like the assumptions. Yes, you are trying to argue that to say this is my assumptions, right? But I'm not actually looking at this question in terms of even ICANN. I'm looking at it in terms of even ACC as a whole, right? There's something you should always look at anytime you are dealing with anything is that what does the standard says? What process am I following? and we said the process we wanted to follow is to say there's an input. In most cases, you won't always have issue in determining your input, because once you have an input and other two other criteria are not there, you are likely to take that your input to become an asset and classify it as either a PPE, yes, PPE generally, and it doesn't become a business. So, but where the issue is do we have an input? So do we have a process or do we have an output? And in this scenario, we are looking at this whatever. Everybody, we are just learning. Everybody just whatever. Everybody agreed there is an input. Everybody agreed there is a process. But where the issue here is that do we have an output? That's the question, is do we have an output? And how do I argue that there's an output? I'm saying yes, for them to have employed senior management staff and for them to have an highly skilled research, that is why I think there's an output. That's why I think there is an output, because my input is there. So, and why I'm thinking that is there an output? Because it told us that they are yet to generate revenue. Now, I want to also buttress on that output. Output is defined as one, dividend that you get, savings that you get. It does not necessarily have to be revenue, rental, your sales invoice itself. We are looking at the bottom line itself. So we are looking at it holistically. We are not just looking at it. Anytime you are making an assumption, you are not just looking at just one item like that to say, we did issue sales invoice. Yeah, they can continue to raise sales invoice. But if company, yes, they have common business, they have been having sales invoice, but practically there's no dividend. I can say yes, there is a business, because yes, ordinarily they are operating. But you as an investor, what we are looking at to say, is there going to be dividends? That is the output I'm looking at, because that's an example of that output. Am I going to have a kind of maybe a share option at the end of the day, even though they are not giving me physical cash, but I'm having a share dividend? That is still an output, right? So it's not necessarily that they must have started invoicing or rental income is the only thing you use to determine. So if they have a senior management staff and highly skilled scientists and they are yet to raise sales invoice, it does not mean that I am arguing on the fact that yes, if they have this thing in place, this company will succeed and there's going to be I'm not looking at it to say they will raise invoice. What if they raise sales invoice and they don't make profit? But I'm looking at it to say yes, once they start, this company is going to be a profitable one. I'm looking at it even beyond sales invoice. I'm looking at the bottom line, I'm looking at the dividend, or what dividend am I going to get in the next few years? What share option am I going to get in this company in the next few years? That's what I'm looking at. I don't know whether it makes sense to you.
I also want to add something, sir, that also for the purpose of ACCA, if our ACA, if I write an exam, I think the three steps, what the three steps are, which is the inputs, the process, and the output. So I think if you start by saying, okay, you first analyze, you write inputs down, and you explain, and you see that input is present, you analyze output is present. Those two, you've gotten those marks already for that. Then when you now come to the third point, which is the output, if you then say there's an output, then it's correct. If you say there's no output and it's wrong, you only miss that step, but you'll have gotten the first two mark. I don't know if that makes sense, sir.
Yeah, and secondly,
Yes,
you don't
thank you
just tell
very
them,
much.
there is an input or there is an output or there's a process. You tell them there is an input, and the reason why the input is because this was considered my input, because there's risk involved. There is a process because they have these are my processes. If they also said there's an output, I must also tell them this is what is going to be the output of this company. It must always be well spelled, not just say yes, is a business or it's not a business. It must come with, I'm not just giving them anything like that. I must actually explain to them as if I'm assuming that whoever is the person that gave me this case does not know anything, and I'm giving to a non-accountant, and I want to explain to them to say this is what because assumption is that that person does not know what a business is, what a process is, what an input is, and that is just the truth. When I joined my company, there's a way I used to present management report every month. And peradventure, the chairman of my company is the CFO of STV News. And he came one day and like, this thing is just too cumbersome. You just go and bring this template they use in STV. And so like, the story is too much. Me as a boy, I don't want to. I just want to see on the highlights. If I'm not clear, I will get to the boardroom. I will ask question. And he went to go and bring one template, and it happens to be a easy template. Along the line, the template has been amended like 3-4 times. I'm like, no, I don't want to see this report. This is not how I want to report it. Though the template is fine, I just want to tweak the template around. So you must actually put out something out there to tell them this is basically what it is, for each of the line to be an input, to be a process, and to also be an output. I think somebody was trying to say something while I was talking there. Hello? So can we continue, please? Can we continue?
Yes, please.
Yes, sir. Thank you, sir.
All right. So having understand what a business is, the next thing we wanted to do is to say how do we account for it, and the recommended method in line with the IFRS is the acquisition method. So, and the acquisition method follows series of procedures. So the first one is to identify the acquirer. Who is the acquirer? The second thing is to determine the acquisition date. The third thing is to recognize and measure the subsidiary identifiable assets and liability. Recognize goodwill or a gain from bargain purchase, right? Or any other non-controlling interest. Identify. So the first one we want to look at is how do we identify the acquirer, right? Or what other thing should we consider? Let me use that word. What other thing should we consider when we are using the acquisition method? So that thing we need to consider is the acquirer usually an entity whose fund management dominates the combined entity. So we should always know when we are making a decision, the acquirer is always an entity. That means is a business. The acquirer is usually the entity whose owner have the largest portion of voting rights. So when we say voting right, that means it has more than 50% equity in that company. But there is an exception to these rules. I know there's one exemption. I don't know whether I have on this slide, whether I will jump to it if I don't have it. The acquirer is normally the bigger entity, which I think collaborates with the first one, right? So in this question, what we're trying to do is to identify who the acquirer. In this question, we are trying to identify how do we know the acquirer. So who wants to read and who can tell me who the acquirer is? Who wants to read? Who wants to read?
Let me read,
Okay.
sir. Okay, I read, please.
Okay. Abacus and Calculator are two public limited companies. The fair values of the net assets of these two companies are $100 million and $60 million respectively. On 31st October 20x1, Abacus incorporates a new company, Phone, in order to effect the combination of Abacus and Calculator. Phone issues its shares to the shareholders of Abacus and Calculator in return for their equity interest. After this, Phone is 60% owned by the former shareholders of Abacus and 40% owned by the former shareholders of Calculator. On the board of Phone are 4 of the former directors of Abacus and 2 of the former directors of Calculator. Required. With regards to the above business combination, discuss which company is the acquirer.
I think you need to have a second read, or you want to answer the question straight away. Who wants to answer the question?
The question, sir, you moved off the question, sir.
Yeah, sorry. I was looking at more question I have to answer. How many question? 5. I'm looking at the time. I'm just time constrained. I'm looking at the time. 6, 7, 8. Okay. We are moving. We have 4 more questions. All right. We are moving. Who is the acquirer? Adejoke, are you going to answer the question? Adejoke is cooking noodles.
Okay, so let me just try.
Abacus is the acquirer.
You're
Yeah.
always trying. Oh yeah, try.
Abacus is the acquirer because from the information that is presented, they already have 100 million worth of assets. Then again, it's also incorporated a new company called Phone. When you come down, another company called Phone, which is a combination of abacus and calculator. Share the whole. So, and again, the Phone is still owned by the former shareholders of abacus. So it's abacus that is the acquirer.
Okay, how do you get to that scenario? Because if I were you in the exam hall, this is how I will attempt the question, right? I will attempt the question on a paragraph per paragraph basis, right?
Sure, that's what I'm going to do. I'm just giving just a kind of so I say let me just try, just a triad. I'm just
I don't want you to try. I want you to answer it. I want you to attempt it. Oh yeah, attempt it now. You have tried. Yeah, attempt it now.
So let me leave it at this now. Then let me.
Adejoke, where are you? Yeah, come on.
So I can learn from others and add to what I have just done.
Adejoke, where are you? Come on. I don't want Sandra to talk.
I want to try.
Yeah, try.
So
Adejoke, are you cooking noodles? You are not talking again, no. Oh yeah, try.
so
Go ahead,
yeah,
shoot.
so okay. So I would say Phone is the newly incorporated company, and to identify the acquirer, Abacus is the acquirer because Abacus shareholders own 60% of Phone, and also the board of directors of Phone constitutes of 4 from Abacus, while 2 from calculators. So with this, Abacus is the acquirer because they have more power or control over Phone based on the number of their shareholders and the directors that will be controlling the company. So that's my answer.
Sorry, I was muted before. Sorry. Okay. So, okay, that's fine. So we are looking at to say Abacus Calculator. Those are the 2 companies, and their net fair value are 160 million, right? And as at 31st of October 2024. I can hear you all the way from the bed on the door. I'm shouting. Okay, don't worry. Sorry, I'm shouting. I won't shout. I will use my voice. I hear arguing with someone. Sorry, is my voice very loud?
Your voice is clear, sir. Not too loud.
It's
Not
okay.
too much. My son told me that my voice is too loud. Yeah, like we can hear you through the thick walls. Okay, I'll bring my
Even
voice.
Fazia.
I'll bring my voice down. Sorry. Sorry, I didn't know my voice was that loud. My bad. So, looking at this question, so we have Abacus calculator. They give us their net asset value. We can't just make any decision because they are just two companies. We can't make any decision. We know their net value. We can only say one is maybe has this value. Then they told us that on 31st of October 2021, after the year end, Abacus incorporates a new company, Phone, in order to effect the combination of Abacus and calculator, right? Phone issue its shares to the shareholders of Abacus. Phone issue its shares to the shareholders of what? Abacus, and calculator in return for their equity interest. So at that point in time, do we say Phone is acquiring Abacus and calculator, or one of them is acquiring Phone? Can we say that? What does that mean? Because nobody actually talk about that. They say Phone issue its shares to the shareholders of Abacus and calculator in return for their equity. So what does that mean to us? Does that make any sense to us? Does that make any sense to us? Does it affect our decision making? Hello? Am I muted?
No, we can hear
Yeah,
you.
we can hear you.
Okay. So does that make any sense to us?
If
Yes.
So what does it mean to us?
yes,
They
he's
said
looking
Phone
at
issue its shares to the shareholders of Abacus and calculator in return for their equity interest. So what does that mean to us?
it means that phone has stake in both abacus and calculator.
So does that make Phone a parent company to Abacus and calculator? Does that make Phone to put Phone in that position? Or we can't make any decision? Or we need to just read ahead?
So let's read further.
Let's read further. Thank you. After this, Phone is 60% owned by the former shareholder of Abacus, right? And 40% owned by the former shareholders of Calculator. That means what the previous statement is telling us is that Abacus is buying 60% in Phone, right? Why Calculator is acquiring 60% in Phone, right? That's what it means, right? Then going further, they said that on the board of Phone, there are two former directors of Abacus and two former directors of Calculator. And what we're trying to determine here is that who is the acquirer? And in our definition, we said acquirer is somebody that has control. If you go to this previous slide, we said that the acquirer, number one is to identify the acquirer. And I said to identify the acquirer, other factor that you need to consider is that the acquirer usually is the entity whose former management dominates the combined entity. That's number one. Look at this last one. The acquirer is normally the bigger entity. Here we say the acquirer is usually the entity whose owners have the largest portion of voting rights. Looking at it, because Abacus has more voting rights, 60% in Phone, that make Abacus the acquirer. Does that make sense to us, please? Does that make sense to us? Or there's any question?
Yeah.
Okay. So can we move on? Can we move on? Can we move on?
Yes,
So,
we can.
So I think I replicate this. The second thing we want to look at is acquisition dates, right? We want to look at acquisition dates, right? So what is acquisition date? We said that acquisition date is the date on which the acquirer obtain control. The date the acquirer obtain control, that's the acquisition date. This will be the date of which goodwill must be calculated. And from which the income and expenses of the acquiree will be what? Consolidated. So acquisition date is a date in which the what? The acquirer take control. And that's when you calculate your goodwill. You calculate another thing and you consolidate the financial statement. Don't forget, when we are talking about business combination, we are not consolidating, no. Anything that has to do with consolidation, because when it comes to consolidation, there are other adjustments that need to be made. But when it comes to business combination, we are not likely to be making adjustments. We are just trying to determine whether there is a control or there is no control, or whether there is a business or there is no business. That's the major thing. We want to determine whether there is a business. Should we consolidate? Should this thing be considered to be consolidated? Should it be considered to be consolidated and there will be a future gain? That is what business combination is all about. Anything that has to do with combination, business combination, merger, it is treated under IFRS 10 because there are more adjustments to be made under that particular standard. But here, you are not making an adjustment. But here, you also to know that, yes, once the acquisition date is the day you think of saying, yes, we can consolidate, you can determine your goodwill and some other thing. Then the next one we want to look at is identifiable asset and liability. The acquirer must measure the identified acquired assets and the liability assumed at their fair value at the acquisition date. IFRS 3 says that an asset is identifiable if, number one, it is capable of disposal separately from the business owning it. Or two, it arises from contractual or legal rights, regardless of whether those rights can be sold separately. So what we are trying to say here is that for you to identify an asset and liability, there are conditions that must happen. And the first condition that must happen is that it is capable of disposal separately from the business. That means if I acquire a business, I should be able to sell it separately from the main business. Right? Two, there must be a contract, there must be a legal right. You must have a legal right to say this, something determining like ownership, to say yes, this is my own. Right? Then the next one, any question before I move on? The next one I want to look at is identifiable asset and ability of a subsidiary should be recognized at fair value if they, one, meet the definition of the asset and liability. So you can only recognize asset and liability if they meet the criteria of what it is an asset or what's the liability. Number two, are exchanged as part of the business combination rather than a separate transaction. That means by the time you acquire 80% in a particular entity, you know you're also acquiring 80% of the assets, you know you're acquiring 80% of the liability. Everything goes, not that you are actually saying I'm acquiring it separately, because when you are looking at acquisition, is not all about what comes in. We consider a lot of things in terms of to say what tax impact is going to have on us if you make this decision. You are looking at the transactional impact on it. So a lot of things goes with it. The items that are not identifiable or do not meet the definition of asset liability are subsumed into the words calculated or purchased goodwill. So anything that you can't say to say this is an asset, this is a liability, definitely the difference between anything that cannot be identified as asset or liability will definitely become a goodwill. which can be a positive or negative one. In most cases, like to be a positive one. Purchase goodwill, right? What do we need to watch out for? What do we need to watch out for? Contingent liability are recognized at fair value. Anything we have contingent liability must always be recognized at fair value. And you know what we call contingent liability? Contingent liability, maybe there is an ongoing court case, right? That is a very big example that is not yet decided, which we don't know whether it's going to be in favor or it's going to affect the company. So contingent liability are recognized at fair value at the date of acquisition. 2, provision for future operating loss cannot be created as it is post-acquisition item. I'm not sure whether I mentioned this in the in the last class, that anything that has to do with provision or anything that has to do with an estimate, I think that's what I used, estimate. An estimate has to be something that has to do with the futures. You must have what did we use? We have a level of certainty, a reliable level of certainty in our estimate, so it doesn't change from time to time. So any provisions, which is an estimate. What did you say?
I think I took provisions last last week, even this week on Monday. I took provisions where I explained contingent liability and contingent assets. I talked about the fact that if it's a contingent asset, that they should not recognize it only when it is virtually certain. They only disclose when it is probable. They disclose it. But if it's virtually certain, they recognize the asset. Then contingent liability, if it is less than 50% that are likely to lose the case, then they recognize it and they also disclose. But if it is more than 50% that are likely to lose the case, then they only disclose. So I
So
took
I
all
don't
of
think I
those.
need to tell more on that
Yeah.
again. So similarly, restructuring costs are only recognized to the extent of the liability, which also still falls on the same item. Then watch out for the following items too as well. Intangible assets are recognized as fair value. You must always recognize your intangible as fair value if they are separate or arise from legal contractual rights. 2, goodwill in the subsidiary individual financial statement is not considered. Goodwill in the subsidiary individual financial statement is not considered. Don't forget that I'm always actually trying not to go into IFRS 10, but don't forget that when it comes to IFRS 10, which has to do with your group, you can have a simple group, and most of the scenario we have been given here. They are just a typical example of, let's say, a simple group. You just acquire 100%. There is no sub. But when it comes to a scenario whereby, yes, I acquire, it can be vertical, it can be horizontal. I acquire 70% in A, I acquire 70% in B, I acquire 20% in C. That becomes an horizontal acquisition. And with that is the complex group. And you can also have what we call a vertical one. I acquire 80% or 60% in A, then I acquire 60% in B. B eventually go and acquire 85% in C, and C eventually go and acquire another 40 or 80, 60% or 65% in D. That becomes an horizontal one, which can be more complex, and there are a lot of adjustments. So what we're trying to say here is that goodwill in the subsidiary of individual financial statements is not considered. This is because it is separate and does not arise from what? Legal or contractual rights. Right. So exemptions. There are requirement of measuring subsidiary net assets at fair value.
The application is trying to connect it. It's not working.
Who's trying to connect it?
Garcia's phone won't.
Sorry, can you just give me 2 minutes or 3 minutes? I'll be back. I'm sorry.
Trying to connect
Okay, sir.
the phone. That's not working.
So while Mr. Badri is away, we can just so we can see that this group account is a bit, it's always a group account is always a bit complex to do. In fact, what we are still doing is we are just touching the baby part of it, which is still like business combination, which is IFRS 3. By the time we go into consolidated financial statement, which is IFRS 10, we'll be doing some things like goodwill, with goodwill calculation, which is usually calculated using what, the purchase consideration less the fair value of the net asset of the entities being acquired, and then you add what's the non-controlling interest of it to get your goodwill. Then you also consider other things such as um, yearly assessment of the goodwill, and such as other things in the consideration, whereby deferred 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 consideration. You have to look at deferred consideration to see if it is more likely to occur or not. I'm just trying to take these things while before Mr. Badru comes in to look into those. At that point of IFRS 10, it's not more a thing of you're looking at, oh, is it a business or not? At that point, you already know it's a business, so you're just looking at the group. It could be a vertical structure, but in the UK, I think for ICANN purpose, ICANN is more tougher compared to ACCA, in my opinion. 'Cause I've done both of them. So ICANN does what is called D group, V shape, straight line, vertical, horizontal. What other ones, if you can remember? V, D. Who can remember another one again? X. There's X also, right? There's X, there's vertical, there's horizontal, there's D shape, there's S shape, and a lot many shape. But all those things that I can't do, ACCA does not do them. That's a good thing about ACCA. Does not do all those things. ACCA said they don't do it, because when I was doing my ACCA class then in K Plan, I asked that, these groups are too simple now. When we're in the class, we're only doing V, straight line, and V, and I think D shape. That's all. I was not asking for what about other ones. They said they don't do it. I say, very easy then, and I end up scoring 89 in the exam because it was too easy compared to ICANN. Although it's a bit technical, so if you want to do, like, I would advise you can do it. ACCA is much easier than ICANN. ICANN is just demonic. So ACCA is much easier than ICANN, but the ACCA is much technical in terms of
Are you sure?
yes. I've done it now. Shebi, I did ACCA now, and I didn't feel any. I scored 89 in what's it called, SBR.
Maybe we should say financial corporate reporting, Abi.
You said what?
Maybe we should say for corporate reporting paper.
Yeah, it's corporate reporting is SBR. I scored 89. So even in what's it called, I did the other ones. I did. I did the UK, even UK this thing. In fact, the one I even did, I did even the UK, which is the most difficult one. People do international own. Which is the one which is IFRS alone. I did both IFRS and UK gap, which made it more difficult to do and to pass. And I still got 89. And then other ones that I did also, I scored 70 something, 60 something in them. So it's not as difficult as I can, but just that you need to pay attention to details, like these small things, these things about this talking about now, like this business combination now, IFRS 3 now, that you can see that some of them, I even miss some of them. But if you can argue it out also, if you can argue it out and give your basis, the examiners will look at it. They are more technical than I can in their question. For example, now ICCA will be looking at questions like, but they can be looking at something like, in a group structure, it might just be one thing they're looking at to test. Unlike ICANN looks at big things to test and many things to test. But I can say look at many things, but just one single thing that will destroy it is what CCA will be looking at, and they'll put in that question. So once you're able to overcome that CCA put in that question, which is a small thing, it might be one, for example, it might be a lease now. ACCA might give you a lease, and they can give you a small lease of, like, they can say the lease is for 24 months, but however, the lease might be $2,000. You know, you I've tried to test small lease exemption, that if the lease is $2,000, you don't need to what, to recognize what present value of the lease, of the future lease term. Do you get? You don't need to do all those, you just need to do what expenses straight. Let's say there's a small thing in that standard, and they'll give you many notes to it. You think it's a big thing you have to do. If you don't know that, and you go and start doing present value of future terms, blah 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 blah, long thing, you have failed that question. All they wanted to do is just expense it. Do you get?
Yeah.
So those are the kind of things they say small things in the exam that you've not read, that you've not read in your standard, is what they test. Since you did not consider to read, since you feel like it's relevant, Jerry, you will not read. Is what they want to test for you in the exam. So why can't is just on their own, they are demonic. I can't like to load you until you die. That's I can. So So I used to say it's still quite easy, but it's expensive. But it's quite easy. To me, oh, in my opinion, this is easy. It's
Okay.
easy to
I
pass
think
because I
Mr.
passed.
Badru has left, so
I think he's yeah. I don't know what happened. Let me ring him.
yeah.
Mm, let me ring him.
It's really expensive. Oh.
Yeah, but if your company can pay for you, they should pay for you.
Hello, can you hear me?
Yes,
Yes,
we
we
can
can
hear
hear
you,
you.
sir.
Yeah, sorry.
Yes, we can hear you, sir.
Sorry. I'm very sorry, my bad.
Yeah, no
Is
problem.
my screen, am I still screen my screen? No.
No.
No. Okay. I think I rebooted my Wi-Fi, so I think it just went off. Okay, I'm trying to share. Do you have right to share? Okay. So you can see my screen now, please. Can you all see my screen, please?
Yes, sir.
Can you see my screen, please?
Yes,
Yes.
sir, we can see it.
All right. So as I was saying, there are exemptions. So say that there are some exemptions to the requirement of measurements in the subsidiary net assets at fair value. When accounting for business combination, assets and liability falling within the scope of the following standard should be valued according to those standards. So when it comes to income tax, is in line with income tax. IFRS 12, employee benefits, IS 19, IFRS 12 for share base, IFRS 2 for share base, and IFRS 5 for non-current assets, held for sales and discontinued operation. I basically think that should be my next slide. But knowledge check 5. But I'm afraid, can I take this lecture in the evening today? I'm just requesting. I need to get on something, please.
Yes, sir, it's fine. You can, if you have to leave, sir, you need to, because I know you didn't mention that by 10 you need to leave. So,
Yes, basically,
so
my I only have a kind of a session
yes.
online. So
I mean, if people cannot come in the evening, you can always just share the slide. They'll go and read on their own, or if they can, then it's fine. So, what do you people think? Can you come in the evening? If you can't, they will just send the slide to you, and you go and read up on your own.
you can also tell me your convenient time as well too. If you can't
Mr.
come in the
Badu is
evening,
the one
you want
taking
to
class
come maybe
tomorrow
during the week.
also. So, but Mr. Badu, you know, right? You know, sir, right?
Yes, I know. Yes, I
Okay.
know. Yeah, yeah, I
I
know.
want to enjoy from your knowledge enough on this. Then I'll
I
be
know very
taking next week. I'll be preparing accounts, live accounts from source documents for everyone. I'll just prepare a full account from bank statement and all that.
So do you want to come in the evening, please? Just tell me your time in the evening.
Time, please.
I can always give you my time, but I want to. I'm the one that is running away.
Let's respond. I mean, that Mr. Moefe, Mr. Upele.
For me, in the evening, I have
Please, I have a
opportunity.
special request.
It
I have
might
I
not be.
have
opportunity.
a
It might not
I
be
have a
evening. It can
one
be late night or two. Anyone combinate for you.
I have a 1 p.m. to 3 p.m. and I have a 8 p.m. to 10. So
Wow,
anything outside that time is fine. Today is like choked up for me.
wow. Okay,
Me,
you know
I
what?
I have like three classes.
Okay, you know what we'll do. If today is not convenient, what I will do is that tomorrow's class, I will continue from here. Then I will shift whatever is supposed to take you tomorrow. Anytime convenient for you during the week, just let me know.
It's okay. That's fine. That's a good plan.
I
So
think
anytime
we took a
Yes.
stand.
during the
We,
week, just let me know.
we took a standard on Monday, so can we also do Monday 6 p.m.?
Monday. Can't,
Yeah, 6 p.m. Monday
no,
is fine.
Monday. Why not make it Tuesday? Okay, maybe I'll join from the train because Monday by then I should be in the train.
6 p.m. in the evening, not morning. No,
Yes, in the evening. Yes, I should be closing by 5. Monday
I
I'm
thought you
going to
work
the
from home.
yes. Monday I'll be going to the office. I work
Okay.
Okay, can I
twice
shift
this
to
year.
7 for you?
It's okay. It's fine.
Or 7:30?
7:30 is better.
Is that
Okay.
okay with Sandra and Aminat?
Is 7:30 okay
Yes.
for every other person?
Yes. Yes.
All right.
7:30.
Sandra, 7:30, 7 o'clock. Is it okay?
I have 7:30. I have 7 o'clock to 8 p.m.
I don't
Sandra,
understand.
what are you doing? I want to be like you.
I'm running an MBA.
Oh.
Okay.
So,
On
so
Monday.
I am always
On Monday. What about
tight
Tuesday?
for me.
What about Tuesday?
Okay, that one, don't worry. I can make it, and I can make an exception for that Monday.
No. What
I
about
can
Tuesday?
work.
Is Tuesday
I can
convenient
work
for
around
you?
this. No, so that Tuesday is even worse. So Monday is okay.
Which day is convenient for you?
I think every day is worse.
That
So
Monday is the only day that is free. Tuesday from 5 to 8 to Friday.
So
So
that
I
Monday,
think
what
that
is the
Monday
most
is
not a
okay. I
convenient
will
time for you
do
on that
that.
Monday? I want to work with your time.
Don't worry, sir. I work with the 7.
Sandra, just pay me. I'll talk to God to increase the time from 24 hours to 38 hours a day for you.
Honestly, I want
Abio.
48. 36 Oleto. 36 Oleto.
That
Okay,
Monday 7:30 is fine.
7:30. All right. So
Yeah.
I will see you tomorrow and we'll also see you on Monday.
Okay, sir.
Thank
All right. Thank you.
you.
Like
All
we are
right.
using Mr. Badre a lot now.
Thank you,
Ah,
sir. God bless you. Thank you.
you're welcome. Welcome.
Thank you, sir.
Thank
Thanks
you
for
so
your
much, sir. Thanks so
thanks for
much
your
for your time.
participation.
Thank you, sir.
Yeah.
Thank you,
All right.
sir.
Thank you, everybody. Have a nice weekend, all.
You
And you
too.
too.
Bye.